And Chris, you get credit. This was from yesterday, so you didn't know that we were going to get better data this morning. What do you mean by bad actors? Because we do seem to have plenty of possible recession culprits out there.
Yeah, Kelly, if we go back to the 01-08 crisis, right? If you look at a recession, it just doesn't happen by accident. It builds up over time. And what I mean by bad actors is you need a group of investors, whether it's corporations or individuals, where their balance sheet are upside down and backwards. They've been doing some really uneconomic things. In 01, it was telecom and it was utilities. If you recall, WorldCom went belly up. You had the likes of Quest and Global Crossing not doing such a great job at managing the balance sheet and so on and so forth. Go back to 08, individuals are flipping condos in Boca and in Miami, and they were leveraging out the balance sheet and everything was great. You look at banks, any risk you put in front of them, they would take down. And there was just way too much leverage, way too much speculation. And those were the weak links. But as we look at the weak links right now, as we look at the consumer, we look at the corporation, we look at banks and financials, we don't see that kind of leverage. We don't see that balance sheet that's upside down that can cause that crisis, that can cause that contraction of credit and liquidity.
Yeah.
Right? If you look at the consumer is quite strong. But let me not interrupt. You had a question there.
Well, I think just to sort of rattle through the list, you say you don't think it's credit markets right now. You don't think it's going to be the spread of Europe's downturn. You don't think it's going to be a monetary policy error. Why don't you think that the Fed tightening into next year could end up really slowing things down quite a lot?
Well, our opinion, our base case was this year you were going to go into some sort of economic slowdown. That's our base case. But again, to push yourself into recession, you really need to see balance sheets stretched. You really need to see uneconomic things happen. When we look at the Fed, if the Fed's going to make a policy error, that policy error is not going to happen until, in all likelihood, the end of the year, until much later in the cycle. The Fed's going to follow what it's being told, right? We're looking at the front end of the curve, rates are going higher. It's going to take a while for the Fed to go outside the norm at this point in time. And until you see something that's outsized, it's really hard to rock the boat. That doesn't mean that things are great. Things are slowing down. They'll continue to slow down. And what we're facing at this point in time is stagflation. And that's a pretty big fear in and unto itself. And
obviously, this is coming from the point of view of equity strategy, not as an economist per se, but for those who say, well, we have parts of the market that are acting like they're already in a downturn, housing, certain parts of transport and retail that are more goods focused as those start to normalize, e-commerce. The retail sales numbers on e-commerce were pretty terrible this morning, even as the overall print was better. So what does this tactically mean for investors as we do have some unique fallout from the post-pandemic period and from inflation pressures?
Yeah, Kelly, I think there's two questions there. The first one is what we hear a lot is, hey, banks are rolling over, defensives are really rallying. This is what happens before a recession. The market's telling you a recession is coming. Well, again, if you go back to the 01-08 crisis, banks didn't always underperform before a recession, right? Banks actually outperformed before the 01 recession and during the 01-02 economic malaise. If you look at defensives, if you look at low volatility, don't actually outperform until you're in a recession. So a lot of signals that you're hearing in the marketplace, a lot of things that people are talking about, they're really not that predictive. To get to the second part of the question is, how should you be positioned? I think for us, in the short term, what we want to do is we want to have a little bit more cyclicality for those who can be tactical. I think you're going to get a bounce during earnings season. I think there's a relief rally, and I think cyclicality is going to work in the short term. But as we get further into the stagflation, as we deal with stagflation more and more, what we think you want to do is you want to barbell your portfolio with growth on one side and low volatility on the other. Because when you have a slowdown in economic growth, there's a scarcity value and people will pay up for it. Furthermore, as you point out, the Fed is being very aggressive. As the Fed gets more aggressive and the economy slows down, in all likelihood, you're going to get more spikes in volatility. You're going to get more pressure. And so that low volatility, that more defensive side of the portfolio will kind of anchor the portfolio and help you out in times of stress.
Yeah, I'm hearing a lot about barbell strategies these days as people try to figure out the right way to navigate this. Chris, great to have you. Thanks so much for your time today.